Rachelle Wilhite, I'm the designated broker and owner of Best Choice Realty. So the topic tonight, I want to talk about strategy about mortgage. Not all mortgage lenders are made alike. And so one of the things we wanted to go over tonight was how to look at different scenarios. So one of the scenarios we'll put up on the screen, things to really think about when you're working with your clients. And we do have some top tips that we were able to gather. Candace and I and Virginia gathered some information from some of our top producers of how they work with mortgage lenders and what do they consider themselves, what do they do to essentially get ahead and set expectations properly. And then they incorporate it into their contingencies. And there are different contingencies you would use for different types of scenarios. So these are strategies to win, and we'll go over that by the end. About 6 o'clock, you'll get to know how we write that up and how we structure our offers to win. Let's go to the next slide. So one of the things that our top producer tips they will do is they will go over and they will set up a consultation. One of the top tips that most of them are doing is they're incorporating that lender into their buying strategy or their consultation strategies. Most of the top producers, they know who to, if they don't have the mortgage person or they don't have Sean that can answer their phone, they will literally do the consultation and have that lender on speed dial so that they can actually run some different scenarios, talk about the strategy, talk about how much money is in reserves, but you're going to want to go over the buying process. And a good part of that is who are you going to use for who's going to help you with your loan? Who have you started that process with? Have the lender take the application while they're there, while they're in your office, while they're on Zoom. That's a top tip that we use. You'll want to review the lender. Let's say you're not able to make that connection at the buyer consultation. Then after you get done with the buyer consultation, another top tip would be to review with the lender, maybe their lender that they've selected, or maybe it's the preferred lender, and discuss maybe some additional options that they may have not considered. If you need to, and I always encourage this, I've got a new buyer, he's a brand new, he's never bought a home before, and he is getting pre-approved. He's pre-approved with his bank and with a credit union. Even I've had him triple app. I actually had him contact Sean, and Sean was able to go over and basically it was called a double app. He could have double apped, but he advised him maybe to just ask a few more questions. So again, Sean, as much as he answers the phone, he's not going to hard sell somebody. If somebody's got a super, super good deal, he's going to keep them with that deal, but maybe give them some ideas or some things to ask their credit union or their bank, depending on the type of program that they're using. So if needed, always suggest a double app. I don't know how many times I've got that comment when I've transacted with a client, but like, Rachelle, I know you're not a lender, but my gosh, you saved me thousands of dollars by suggesting that I get a second opinion or just double app with another lender or your preferred lender, just to make them feel comfortable with that lending process. You also, one of the things that are key to strategy with a lender is to expand the search terms to maybe include some different things. So for example, if you're looking at homes, maybe a cash out conventional, and you notice in a certain area that this house may go FHA or may be a VA approved house, the listing agent just did a poor job of marketing it. I've been able to create inventory when there has not been inventory because of the experience that I have with certain lending programs. And I'd be able to call a lender and then call the listing agent and say, before I even take the client out on a tour, if this will not go VA because the electrical panel is recalled, let me write and strategize and make sure there's a program, but I think we can write that into the purchase and sale agreement, and then we can be eligible. My VA buyer will then have a house. This doesn't work on every property, but if you understand the search and the terms and you're working in conjunction with a top lender or that has programs, for example, a manufactured home product, that might be able to strategize with that listing agent to make that home qualify, you may have some more opportunities that you didn't have before. So when you're restricted in budget or you're restricted in location or in the term, like what type of product that you can do, expanding the search, working with that lender can oftentimes bring you a home run. The right side is a text message. I love how Shannon is exchanging a text message with this Emerson. I love how that kind of happened. What time are you thinking? Again, she's engaging. You can see a lot of clients will start the process of like, ooh, I don't know about financing and I don't know about, that's where Shannon wants to engage and get that client to meet in person. You can do so much more in person than you can by text. So when you start talking about financing, or I don't know if I'm pre-approved or what the next steps would be, they're all Emerson's basically encouraging Shannon to go ahead and let's get something set up. So hers like, absolutely. Do you have time to meet up on Friday? What time were you thinking? I'm flexible. Let's get the lender on board. I believe that's what you did, Shannon, on here. And then we had, go to the next slide. You could, that'd be great. The scenario. So then we found the house and we wanted to run some scenarios, and I wanted to, Shannon said, don't pull anything. So we didn't want to pull any kind of scenarios, but we wanted to see the kind of results we get by sending this property and this situation over to a few different lenders to see if it's worth it to buy the neighbor's house next door that's requiring some small fix-ups, to do a rehab loan, and then can take in consideration this particular borrower situation. And again, 550 to 650, very fast moving. So we had to know what this particular borrower would qualify for. So we ran the scenario, and this is the one lender's response. I mean, this person said, ugly numbers alert, 20% down. Non-owner would be 7.375 for 3.5 points. Total payment would be 3770. So the left-hand side is not what we're wanting. We're not wanting somebody a lender to say ugly numbers alert. I mean, that right there doesn't make you feel good. If you're a borrower and you got this text message, I would feel like, oh my gosh, I'm on alert. It's not the type of thing you want. A lender that's going to strategize with you on what are your goals. Just like you would work with that buyer, you're looking for a lender who's also going to mirror and match the strategy. And then the right-hand side, thanks for reaching out regarding the investment property. Due to market conditions, 25% or more down would be more favorable in terms of rate. You did 25% down, here are the scenarios. And then they broke down the scenarios. So that's a much more thoughtful lender on the right-hand side than on the left-hand side. Is that right, Shannon? Did I kind of go over that correctly?
Yeah, I mean, the lender's responses can be different. I mean, maybe that client needs an ugly numbers alert, but for first-time home buyers, they don't want to be spooked like that. So I think it's all about the matchmaking process and making sure you've got a lender fit for the client to get them the answers that they need.
That's great. Okay, let's go to the next slide. So I'm going to go into more of the strategy around the finance contingency, because when you're working with a buyer and they said, okay, Rachelle, I've made application with your lender, I've made application with my credit union, so we're double apped now. Then it's kind of asking them some questions about their comfort level about how to structure the offer. So a lot of you have not been properly trained. Most people just kind of go through the motions, like give me a boilerplate, and they throw the 22A or the finance contingency into the mix of the paperwork. And they really don't understand the strategy around how to structure the offer to win. And I pride myself in making sure that if we have a shot at getting this house and getting this property for them, that my buyer is going to understand the risks and the benefits of going with one form over another. So I'm going to start out with the forms that you would use that would be the most risk for the buyer. Because again, we're in a very competitive area. If I was looking at anywhere from 500 to 600K in a certain area of the Puget Sound region, that's first-time home buyer bracket, and it's very competitive right now. And so we do have to understand how long has the property been on the market? What other offers are we up against? What's the competition like? These are some of the questions I'm asking the listing agent to understand, how competitive do I have to be with my buyer who is double apt? This guy has been on this job for over 10 years. He's a first-time home buyer. He's saved up money for his down payment. He's completely pre-approved. He's basically triple approved. I had Sean reach out to him. He's approved with his credit union and with his bank. I've got letters that are updated, and he's definitely approved up to 535. So in this case, I need to talk with my client. We'll just call him, his name is Mitch. We'll call him Mitch. And Mitch is trying to figure out, okay, I want to put an offer. I found this house, the house maybe that Shannon had on the screen before. He wants to write the offer, but he's most likely going to be competing with another offer. In that case, do we have to have a finance contingency? And I'm just going to pick on Tara. Tara, do you have to have finance contingency to write the offer?
No.
No. So when we are doing structuring the offer, we have to ask what is most important to them. So are you comfortable? The question I would ask Mitch, I'd say, are you comfortable waiving your finance contingency altogether? And he's like, oh, dang, no, I don't want to do that. Okay, well, are you comfortable waiving just the appraisal? There's a separate addendum. So we can kind of work our way backwards. Sometimes it's easier to say, do we need a finance contingency? And if he says, no, I'm solid. I'm pre-approved for everything. I'm comfortable with my job. I've got my down payment. I actually don't even think we'll have a problem getting the appraisal to come in. If they're that savvy with the process and we're competing with cash, you may not need a finance contingency. In fact, in some areas of King County, in order to win, you will not be able to put a 22A into the mix. And many of you are probably still using 22A and checking a box that you shouldn't be checking and thinking that you're waiving when you're not. When in fact you're not. You actually have to use, and this is the form I would use if I was waiving my finance contingency in that situation with Mitch, who is very solid, who is triple apt himself. I went ahead and created a 22. You could create a 22 EF, and then you would check not box number 2, you would check box number 3 and indicate the loan. So I would write on the loan section on number 3, line 23, I would put on there PRMG 10% down loan. You could just put PRMG, just who the lender is on the loan. If you check the other box, you could put checking account, 50% is coming from a checking account, 50% is from PRMG. Whatever the situation is, you're just disclosing the funds. It is not a contingency. So even though it says evidence of, it says disclosure of contingent funds, that does not mean it's a contingency. I think it gets lost in translation, especially for some of you guys that speak different languages. Number 3, if I check the box and it says disclosure of contingent funds, that does not mean it's a contingency. It does, however, provide an opportunity for the seller to cancel the transaction if for some reason your funds, the funds that PRMG and your bank account, they don't get the funds in time. If the default is 10 days, your funds have got to be at escrow 10 days before closing. So be sure that that yellow section that we have there on the form, that you change the 10-day default and change it anywhere from 1 to 3 days before closing. That's usually what we see with evidence of funds. So in my case, I would probably put 1 day before closing, the funds will be at escrow. And if for some reason the lender's not able to get the funds to escrow within that time frame, then it is a seller contingency. It says upon seller's notice of termination, the seller, if the funds are not there for whatever reason, the seller then could terminate the deal, and then you would be out. You wouldn't get the house, and then the seller could cancel. So that's a seller contingency that's built into the 22EF evidence of funds, but it's not a contingency. It's only a contingency that's built in for the seller to terminate if your funds are not at escrow 1 day before closing. And again, it's 10 days, watch that default. It's a backwards clause or a 10-day default before closing. So it trips people up a lot if you're not reading your forms. Okay, so this is how you compete with cash. And you would write up the evidence of funds. And then again, it's just getting us those funds to escrow as soon as you possibly can. So you have to work very, very quickly with your lender to make sure you can meet that closing date and make sure that the loan documents are at escrow. This is the same form you would use for hard money. If you're going to do a hard money loan, this is usually how you would disclose that. You would end up writing that on number 3 as well. If it's cash, you don't use number 3. You just use number 2, and then you provide proof of funds. Or sometimes you check box 2 and 3 and kind of show where those funds are coming from. Okay, let's go to the next slide. The next layer of protection would be if I was not going to, my client Mitch, he's not comfortable with waiving everything. Basically, he wants some sort of contingency, maybe to protect his appraisal, because his lender's like, we need to get an appraisal on the place. And he does not want to overpay. So if he's like he's comfortable with his job, comfortable with underwriting because he's double app, triple app in my case with 3 different lenders, he's comfortable with the financing process and making sure that he has somebody that can loan him the money, then all he's wanting to provide is an appraisal contingency to protect him in case the appraisal does not come in at the value. Say we're escalating up to a certain price and he's just wanting some protection on the appraisal only, then he could use a 22AA and not use a 22A. You don't use both. So some people have been confused and they throw a 22AA and a 22A. You don't use both. You have to pick which a contingency you want. This isn't a contingency. This is contingent on the appraisal coming in at the value that you have, that you agree upon. So in the case of an escalation, whatever the purchase price is, with the escalated purchase price that we're paying on the 35E, then the appraisal addendum would protect that from making sure that you can get a loan that will have an appraisal for that. Essentially, what they've done is taken the language from the 22A and placed it in its own contingency or its own addendum. It's not to be used together with the other, with the 22A. Okay, it is a 21-day period or a 20-day period waiver. If you're in a multiple offer situation, what I've done to win is I've cut that timeline down because usually you can pay for a rush on the appraisal. And so you can often get that appraisal done. You'll want to talk with the lender who you're using. So I call PRMG and talk to Sean and say, Sean, how quickly can you get the appraisal? I'm going to waive the inspection. We're going to waive, the Form 17. I'm waiving all the things because I'm up against a cash offer, but my client just wants to make sure that we get the appraiser out there within the next week. Is that possible? And if he says, no, they're backed up, I can't get an appraiser out there for a week, or I can pay for a rush and get the appraiser to get it turned in within a week, then I may want to put my number 5 on that form, maybe put 10 days or 7 days. Again, work with the lender because then you may be able to cut that timeline way down and compete. So that's a great strategy if if you have a buyer who's a little bit nervous about the ending purchase price, making sure that the appraisal comes in at the valuation. Let's go to the next slide. So this is another strategy that can be used. Now, unlike the 22AA, the 22AD is something you can use in conjunction with the 22A. And you can actually use this with the conjunction of the 22AA. So this is one where you can use it if you are wanting to show strength that your buyer or your borrower has additional down payment. In my case, Mitchell has had, he saved up money for the down payment, but if let's say the house didn't appraise, he does have some additional down he could do. So instead of putting 10% down, he could probably do 12% or 13% down. I have to do some math with the lender, but this might be a strategy that we use where we're including a 22AA, and then we're using the 22AD to show that we have the ability to come in with additional down. We're pre-negotiating that. So in the case of using the 22AA, I am going to be using the section number 2 that matches with the 22AA. I'm not using the number 1 because that one matches with the 22A. So you check the appropriate box. It says in parentheses that goes with the 22A, but it's confusing because they put both of them on the form. They put the 22A kind of additional down strategy with number 1, but the one that we're talking about here is if we use the 22AA, we would use the checkbox number 2 if we're going to use that strategy. And that we have to put in how much he's willing to bring in. So in my case, an additional 2% more. So we could put that in section A, and then we could additional down payment. Buyer shall pay whatever in purchase price, and then the additional down payment, how much he's willing to pay in addition to the other, whatever he's agreeing to from the lender. And then the notice has to be done with 3 days. It cuts your timeline down. So it's doing that in the 22AD. It's cutting your response time for if the appraisal does not come in at value, then you have less time than a traditional route to go. Does that make sense? Did I cover that well enough, Shannon, or do I need to? Tara, Shannon, let me know.
Yeah.
Thumbs up. Okay. Let's go to the next slide. So then we've got the next layer of, I guess that's more protection, a mutual protection, right? Sellers willing to concede, buyers willing to concede, but this 22A, this is where it's sometimes confusing, is a lot of you think Well, if I just do the waiver of finance contingency, I had this happen with another agent from another company. She thought that this, by checking 2B, that they were waiving the contingency. Didn't even understand, didn't even read that the waiver only occurs automatically after that period of 21 days. So this is where you can have, so another layer of protection for your buyer would be to keep the 22A, but then maybe just cut down the difference between the 2A and the 2B. The 2B is only waived after a period of time, where the 22A term 2A, the seller has to actually trigger that form, which is the 22AR, to then get you to remove your contingency. So it doesn't automatically, the contingency doesn't automatically expire like the 2B. So the 2B is actually better for the seller, but it's still protecting your buyer for that period of time. Once that time is up, then their earnest money becomes non-refundable and the seller would get to retain that. Whereas if they were going to go and check the box on 2A, the seller on day 21, let's say the 21 2A was checked rather than what we have here on the screen, that would mean that I would have to, as a listing agent, send you over a notice that would give you 3 days to remove the contingency or not. So the 22A term 2A is in the best interest of the buyer, but in a multiple offer situation, or I've just pretty much have just decided 2B is the way we're going to do it, because I don't want to have to go back and forth with 22A and have this conversation with the buyer and the seller to help them understand that your earnest money is gone, or your earnest money, you've already missed your timelines. It's very, very clean. It's clean when you use the 2B rather than the 2A. So I'd rather see you understand the difference between the 2A and the 2B. Maybe one of these days, Shannon, will make a worksheet, right? To have them
Yeah,
explain.
it's funny how many times people misunderstand it, where one is not necessarily better for the other in terms of how they function. Their goal is ultimately to establish when the financing contingency will be waived. But the only difference is the notices.
Yeah.
So if you're a good listing agent or you have a transaction coordinator and you're following your dates really closely, and you know that you yourself will send that 22AR notice, then in essence, the 2A is really no different than a 2B because it does have that in place. But if you're just wanting to have less paperwork and you have a very firm concrete date to work from, the 2B is going to be a lot easier for people to kind of plan ahead in that way. The reason that it could be perceived as being better for the buyer is because if the seller never provides you with the 22AR, then your financing contingency is always going to be in play.
All the way up until closing,
Yeah.
which is how it is in a lot of different places. Other states are going to be very firm. They're going to have an actual date written into their purchase and sale agreement. So when you're dealing with people from out of state or sellers that maybe are moving to another state and they're like, well, I can't plan my move until I know that the earnest money is non-refundable, and they get really, really worried. If you're working with sellers like that, you may want to go ahead and counter the buyers because you won't know. And it becomes very uneasy when you get to day 21, day 22, day 23, or you're a couple days from closing and your seller thinks they're going to get to keep the earnest money. They're not. That earnest money, unless you have had them waive the financing contingency on, and with the 22AR, if the box 2A is checked, which is the default of 22A, they're not going to be getting their earnest money back. In fact, they're going to be going back to market very frustrated with you as a listing agent because you didn't advocate on their behalf. You really should, as a listing agent, have a good understanding of knowing the difference between the 2A and the 2B. And the 2B is much better for the seller because you actually have a date that you have to have that money, that the money has got to be underwritten approval, essentially, minus the appraisal. Notice that the appraisal on 2B is an appraisal less than the sales price. The default, it says will not. So most of the defaults of either the 2A or 2B, that appraisal contingency, let's say the appraisal doesn't get ordered for a long time, we just had this happen, that appraisal actually will not constitute the waiver. So they might waive their on day 21, they've waived their finance contingency, but at appraisal contingency, if the appraiser hasn't done their job or has to go back out, that actually stays and gives you more time. That's the
It's
difference
still in
between.
play. Yeah, it is a common kind of misunderstanding as well with the 22A is how the appraisal gets into effect when the financing contingency has already been waived. It's still embedded.
It
So
is.
if you read that term, it says buyer's waiver of the financing contingency will not constitute waiver of appraisal less than sales price. It says it right there. If you just finish the sentence,
Yep.
it tells you it's not waived. So just leave the defaults alone and it'll add that protection for your buyer.
So some other top producer tips that we wanted to throw at you guys today as well when you're dealing with 22A, because even though I taught you how about the 22AA and the 22AD, and I taught you about 22EF, not including the 22A altogether, we're still going to have most of the people writing 22As and then trying to figure out the difference between the 2A and the 2B, which is good. So a couple good things that you'll want to be aware of is that sometimes when you're looking at multiple offers, and I'm trying as a listing agent to decide between one offer over another, it can be as simple as the commission based off of the net price or having some sort of indication of how the commission's being applied. If the earnest money or let's say the purchase price, what the 35E goes up to say 550, and we have the 22AD on there and we've got the 22A on there, and so the buyer is like excited and the escalation's part of it, and you're like, well, why didn't I get the deal? It could be as simple as that the commission that the seller had to pay more in commission to net the seller less than say somebody that might have thought through that part on how the commission is applied too. So think about how you write your commission. You may have to do a credit. You might have to use a 41C and give part of your commission, especially if you're escalating. That might be something to think about. That's more advanced. Using 41C if you're trying to also think about getting the price elevated, but that's something to consider. Also increasing the price to cover closing costs. Commission is also applied on that increased amount. So you may want to think about how you structure closing costs too.
Yeah,
Sometimes
that comes up quite a bit. So if you've got an offer that's at 300 and then you have another one that's offering 310, but it's asking for 10,000 in closing costs, what's the seller going to see? I mean,
yeah,
it's kind of like they're the same offer in that respect because they're
they are, but
netting
then
the
the
same.
difference is the commission's based off the 310, right?
Exactly.
Rather than the 300. So
Yeah.
think about that when you're factoring closing costs and using 22A, 2B, 2A versus 2B. Again, it's just cleaner if you keep the dates less. Again, you don't want to have that seller counter you if you can avoid it. You want a nice firm offer. And then the appraisal consideration. So the difference between the will and the will not, I have top producers that have been with Best Choice for over a decade that still ask me, remind me again how this will or this will not works. Is it better for the will or the will not? And it's better for the seller to have it will. I mean, if the will is checked, that means it's all bundled into that same timeline. If you don't have the 22A all together, you still have to have the appraisal, but then your client is making, if you didn't have a 22A or a 22AD, your client has got to be able to have the funds to be able to come in case the appraisal does not come in. Otherwise, you lose your earnest money. That's the repercussions, is the forfeiture of the earnest money. So if somebody's willing to, $50,000 is on the line, and they're okay losing 50 grand and waiving everything, waiving the financing, waiving the appraisal, and waiving everything, then go for it. But sometimes it's not that case. It becomes very important to know where your client stands on those issues.
Yeah, I think so. I know this is probably just a reminder, but in terms of like protections in place between all of these, the 22A, 22AA, the 22AD, the 22EF, but we have a lot of forms, but the 22A will offer the most protection for your buyer if they're financed, right? So the most protection. If you're trying to eliminate protections, then it's the 22A that we talked about, the appraisal addendum, which is already embedded in the financing contingency. So it's like you're eliminating an element of protection. And then the next level from that is the 22EF, where there is no financing contingency protection. There's no appraisal contingency protection either.
Right. So this is going backwards. So Shannon was able to go backwards in her mind from I started with least protection to most, and then she just recapped for you guys to go from most protection to least.
Right.
But those are the forms you have available to you, and you should use something to disclose where those funds are coming from. Most sellers are going to want to know how you're going to structure it, even if you're cash. They're going to want to know some proof of funds, or they're going to want to know what pre-approval letter. I get asked that a lot. Well, my offer is valid, even if I don't have a yes, that's true. But the sellers can still decide whether they want to accept based on your credit worthiness or your financial ability, or whether you have the funds. They can still discriminate whether you have financing, a financing contingency or not. That will sometimes make their decision on who they go with, on how you structure the offer. I think that's the last slide. Is that right? Yeah, we're here to help.
Mhm.
So we'll open it up for question and a little bit of question and answer tonight. 6:04. We have got about 5-10 minutes. Love to open it up for questions that you guys might have. And welcome to some of you who are new. Welcome to Best Choice. Good to see you, Terry. And to unmute your line, just click on the little microphone, or if you want to chat, go ahead and put a question in the chat.
It's good to see you all too. I'm enjoying the discussion.
Great. Nice to see you. Any other questions, Terry? Did you have any questions that we didn't cover tonight?
No, I thought you did a great job of covering everything. Good strategy.
Awesome. A little bit of review. Doesn't
Yeah.
hurt, right?
Never a bad thing.
Question out there in the field. Shannon, anything that came in from you?
No, but we do get questions about proof of funds from time to time. So, if I've got a cash buyer and I guess, what happens if I don't supply proof of funds? How does that work?
On the cash buyer,
Yep.
specifically with the cash buyer, if you don't provide proof of funds, you better hope that those funds get to escrow before that closing date. That's the drop down dead date, that you have to have those funds at escrow. If you pass the closing date and the funds don't get into escrow at that time, then the seller can terminate and you can lose your earnest money. Okay. All right.
And then another question that actually comes up from time to time too. I'm a cash buyer. Why would I include a 22EF? What if I just excluded it in my offer? What does that mean? How does that impact my offer compared to another one that is cash that did include the 22EF?
Can you go back to the 22F? Let me show on the screen. It's easier to show right there. It's because of that section. So you could obviously have a proof of funds. I'm with Bank of America. Here's my $2 million that I have in my bank account, and I don't need to use the 22EF. The difference though is if you have a seller, and I use this story as an illustration. We were up against a Windermere. It was a $3.5 million purchase. And we were up against, Best Choice Realty was up against another Windermere agent. So Windermere listing, Windermere buyer's agent. There was only 2 offers on the table. The offers were only $5,000 apart from each other. And the only difference, and they're both cash offers. So the only difference between the 2 offers, and because they were so upset. The agents were upset, the clients were upset, they were in the office, and I had to call the designated broker. And the only difference when we compared the 2 offers side by side was because we had proof of funds from Bank of America for the $3.5 million. And then Windermere had proof of funds as well of where the funds were coming from. The difference though was Windermere used the 22EF that gave the seller more comfort, knowing that they could terminate if those funds that were on that statement or on that bank statement were actually at escrow. That was the only difference. And they actually went with something that was $5,000 less. Ours was $5,000 more, but the sellers felt more comfortable because there was this section that Shannon highlighted here that was part of the contract, and the 22EF, it gave the sellers more comfort, and that was the only difference. And I had to go back and explain that, and that story just still sits with me today. That was like 7 years ago that happened. But we lost that deal, and we had to go back out to the market and find another house. And it was like one of those houses where it was one of a kind. Can't find the same house, the same terms. And if we had to do it over again, this agent that represented that seller and that buyer, the buyer, I still know the seller's agent, but the buyer's agent definitely uses 22EF with every single offer she writes when she's working with a cash buyer. But she definitely makes sure that she changes that 10 days to 1 day because that was her hang up, was like, well, I don't think that I need to use this because it's 10 days and the funds are going to get there right away. And she just wasn't understanding how the protection works for the seller in the case of an out-of-state money that's coming from a different country. Again, sellers kind of make decisions very, very interestingly when they're stuck in a room and they have to, you know, go with this offer over another. It can make that much of a difference to them with just that protection there. Hopefully that helped, Shannon,
Yeah.
with the question. Anything else?
I had one that came up this week. They were wanting to know if the 22A or the 22EF was better for a home equity loan. The 22A now has that box as a loan.
Comes down to the comfort level of that homeowner. So if they're wanting more protection, then yes, the 22A is going to have a lot more protection. But if you're up against a multiple offer and you're feeling pretty strongly that you'll have some way of financing, you know, without going that route, then 22EF is plenty. I mean, it's just disclosing that they're getting a HELOC. But then they're risking their earnest money. So whatever money they put down on that first page of the purchase and sale, that money will become non-refundable from the moment you go mutual acceptance, unless you have an inspection contingency. So that might work good to get you the deal, but it also might put a lot of strain on your relationship. Yeah.
Yeah, and I think one of just the last reminders too, because I know we were talking about lenders and double apping, triple apping. I think it's a good reminder for all of us about the shopping clause that's on the
Yes.
22A, where right after it's in the first term that's there after you indicate the amount down, it's the number of days you have to make application with the lender. And just a reminder, because we had one that was really pretty dang close this week. Over the weekend
It
where
was like day 4, wasn't it? We got it.
yeah. And so just be careful that basically the way you can explain it to your client is call it the shopping clause and say you have 4 or 5 days to shop rates, shop lenders, shop companies in that way. But afterwards you're locked in unless you have permission from the seller. So don't be making application after that date unless you have permission, because you could
No.
in essence be
You could breach your
risking your
contract.
financing contingency.
Yeah, you're waiving automatically if that happens. So it's
Yeah, but
not
with
hard
that
for
being-
that.
With that being said, though, we also want to know that Sean, if you don't go through him, can also rescue a loan if something goes sideways.
Mhm.
So
Yep, we've
before you
done quite a
totally
few.
terminate, find out if they're willing for you to look for alternatives.
Well,
Yeah,
that
Sean's
double
res-
lapping is the way to go, right?
Yes.
Yep.
Yeah, Sean's rescued a DHI loan before too. I mean, something from DR Horton, a new construction builder. So I mean that not all lenders have the same programs or look at their underwriters look at the situation the same way. And so if you do get a denial or you have a situation where just like, I just need another set of eyes on this, that's what we have a preferred lender for. I let you guys select, and it's based on service and it's based on making sure that it's the right match, but certainly you want to have another set of eyes on something like that. It doesn't seem right. Okay, let's wrap for the day. Thank you so much for jumping on. Appreciate all your time and good luck out there. It's very busy. It's a very busy Monday, so I'm expecting big things this week and into next weekend. Have a great night,
Yep.
you guys.
Bye, you guys.
Thanks. See you.